Alright traders, let's get right into it. Tomorrow's shaping up to be one of those days where patience and precision are going to matter more than usual. We're coming off a choppy session today with mixed sentiment across risk assets, and FX traders are walking into a market with a bit of a split personality. There's nervous energy building ahead of key US data drops and lingering central bank speculation. Let's walk through the majors, get you some levels, flag the event risks, and talk strategy. Right now, euro to US dollar is hovering around that 1.0640 region, and it's doing so without much conviction. Technically, we've got support building down at 1.0600, psychological and structural, with stronger footing around 1.0570, which held nicely on the last pullback. On the top side, resistance is stacked near 1.0680, and then again up around 1.0720, which is a neckline from the mid-March consolidation. If you're scalping or swinging tomorrow, keep an eye on 1.0665. A clean break above that with momentum could trigger a test of 1.0720, especially if US data misses expectations. But if we get a bounce off resistance and yields tick higher, look for a fade back toward 1.0600. Catalyst to watch: Eurozone ZEW sentiment data hits in the morning. Not a huge mover typically, but it might add weight if it disappoints, especially paired with any dollar strength. More importantly, US retail sales numbers drop at 8:30 a.m. Eastern Time. A hot print there recharges the dollar bulls quickly. Bias: neutral to bearish unless we clear 1.0680 cleanly. Pound sterling to US dollar, range bound but sensitive. Cables trading like it's caught between narratives. Inflation in the UK is still sticky, but recession warnings haven't disappeared. Pound sterling to US dollar is sitting around 1.2460 right now, with short-term resistance up at 1.2520, and stronger resistance lurking around 1.2585. Support is firmer near 1.2400, then again at 1.2340, which is your last line before we risk a deeper slide. Now, here's the kicker: there's not much UK data on the docket tomorrow, so this pair is likely to dance to the tune of US risk flows. If dollar strength continues on retail sales data or Fed rhetoric, we could see a squeeze back toward 1.2400 or lower. What to watch: any mention of inflation persistence or wage growth from US Fed speakers could pressure this pair lower. But if equities catch a risk-on bid and the dollar softens, pound sterling to US dollar has room to grind higher into resistance. Bias: slightly bearish intraday unless we break and hold above 1.2520. Fade rallies unless sentiment flips. Dollar-yen continues to walk a tightrope above 153.00, now trading around 153.85. This pair's a beast lately, fueled by US yields and a very hands-off Bank of Japan, at least for now. Short-term resistance sits at 154.20 and the longer-term stretch target is 155.00, which markets are eyeing as a potential MOF intervention trigger. Support levels come in at 153.20, then more meaningfully at 152.65. If you're playing this pair, tread carefully near highs. Intervention risks aren't just hypothetical anymore. Key driver: US retail sales. A hot number sends US yields higher, and the pair likely tests 154.20 plus. A weak number, though, could push it back under 153.50. Keep one eye on the 10-year Treasury yields while you're trading this, still the clearest driver. Bias: bullish short-term with tight stops near 153.20. Caution above 154.20, don't get caught in an intervention flush. Economic calendar: what actually matters tomorrow? Tuesday's key event: US retail sales, 8:30 a.m. Eastern Time. This one's big. Markets want to know if the consumer's still holding up. A strong print will push the dollar higher, raise rate expectations, and potentially lift US dollar to Japanese yen and sink euro to US dollar and pound sterling to US dollar. Also on the radar, Fed's Bowman and Barkin speak throughout the day. Neither is usually a huge mover unless they stray from the script, but post-CPI commentary could spark intraday moves. ZEW sentiment out of Germany in the early session. No BOE or ECB speakers lined up tomorrow, but that can always change. Market sentiment, jumpy and data dependent. Sentiment right now is fragile. Traders are still digesting last week's CPI surprise, and there's a growing sense that rate cuts might not come as quickly as the market hoped a month ago. Equities look stretched, and the dollar's reclaiming its footing. That's your backdrop. The big thing here. No one wants to get caught offside before the data drops. That means lower liquidity ahead of the print and sharper reactions after. Be nimble. Trading tips for the next day. Wait for the data reaction before committing to a directional bias. If you're already in positions, tighten your stops going into US retail sales. This print can reshape sentiment fast. Watch the DXY, dollar index. It's holding above 105.00. A break higher strengthens the bearish case for euro to US dollar and pound sterling to US dollar. Respect resistance in US dollar to Japanese yen. If we approach 155.00 tomorrow or the next day, expect headlines about possible intervention. Don't hold longs blindly through that zone. Entry zones, euro to US dollar. Look to short near 1.0680 if momentum fades. Possible long around 1.0570 if the dollar weakens. Pound sterling to US dollar, fade strength into 1.2520 with stops above. Look for reaction at 1.2400 for support plays. US dollar to Japanese yen. By dips near 153.30 to 153.20. Don't chase above 154.20 unless volume and yield support it. Risk management, limit size ahead of the US data. You can always scale in after volatility cools. Set alerts at key levels and don't get married to any single bias. Tomorrow's not the day for hero trades. Final word. Tomorrow isn't about overtrading, it's about reading the tape after the numbers and riding the wave that follows. If US retail sales surprise to the upside, we could see some sharp dollar buying. But if the data misses, we're likely in for some chop followed by dollar weakness. Stay nimble, keep your stops tight, and let price confirm your bias. Catch you back at the charts.